Nvidia is sitting on $50 billion in cash. In June, it borrowed $25 billion more. It had about $8.5 billion of debt to refinance. It made $49 billion of free cash flow in a single quarter. It did not need the money. On Wednesday, Nvidia reports, several million people are going to look at the revenue line, and the revenue line is not going to tell them anything they do not already know. By the end of this, you will know the one line in Wednesday's filing that actually moves, exactly where it sits, what it said last time, and what it means in both directions. I want to be clear about what this is. This is not a view on the share price, and it is not advice. It is a reading guide for one filing, built from Nvidia's own documents. Here is the strange part. The two most famous arguments about Nvidia right now, the bull case and the bear case, are both quoting the same line. Neither of them is quoting the current version of it. That line is where the whole week actually is. Start with why the headline cannot help you. Last quarter, Nvidia did $81.6 billion of revenue, up 85% on the year before. Data center alone was $75.2 billion, up 92%. The company then guided this quarter to $91 billion, give or take 2%. So, on Wednesday, revenue will be about $91 billion. Everybody knows that. Nvidia told them in May, analysts have earnings at a bit over $2 a share against $1.05 a year ago. When a company guides a number and then prints that number, the print carries almost no information. It is a rounding error against a forecast the market has had for 3 months. What people actually want to know is different. They want to know whether the demand behind it is real and whether it lasts. Revenue cannot answer that because revenue is the past. Guidance cannot answer it either, because guidance is a sentence management chooses to write. There is one number in the filing that is neither. It is the number where Nvidia has to spend its own money to be wrong. It is called manufacturing, supply and capacity commitments, and it is a single line in the notes. Here is what it is. Before Nvidia can sell you a chip, somebody has to make it. Capacity at that scale is not something you buy in a week, so Nvidia goes to its suppliers years ahead and commits. It agrees to take wafers and memory and packaging capacity on a schedule before the orders for the finished product exist. That commitment is a forecast, but it is not a forecast in a press release. It is a forecast Nvidia has signed and in large part paid for. Last quarter, that line was $119 billion. $95 billion of it falls due inside the rest of this financial year. The rest runs out to 2031. Now, hold that against the guidance. Nvidia told the market to expect $91 billion of revenue this quarter. It has committed more than a full quarter of revenue to its suppliers before a single one of those chips has been sold to anybody. That is not a normal way to run a chip company. And that is the argument, because two very different people are looking at that number and reaching opposite conclusions. In February, Michael Burry, who is famous for being early on the housing crisis, wrote about this line. He pointed out that in the annual report, the purchase obligations had gone from $16.1 billion to $95.2 billion in 12 months, 6 times in a year. His comparison was Cisco in 2000. Cisco locked in supply expecting growth to keep running at 50%. The spending stopped, and it wrote down billions of dollars of equipment nobody wanted. The shares fell more than 80%. And on the other side, analysts at Rosenblatt looked at the identical disclosure and called it evidence of confidence. Management securing capacity years out because it can see demand nobody else can. Same line, same filing. One says risk, one says conviction. Here is our reading. And this is analysis rather than reporting, so treat it as ours. They are both wrong about what the line is. It is not a verdict at all. It is a speedometer. It does not tell you where the car ends up. It tells you how fast it is going right now. And before we go further, the honest objection, because it is a real one. Nvidia's own note says that in certain instances these agreements are cancelable, able to be rescheduled, or adjustable for its business needs before firm orders are placed. So this is not debt. Nobody can turn up and demand $119 billion. Some of it can be walked back. Note the words, though. In certain instances. Some agreements. Not all of them. And the filing does not tell you the split. And we have a receipt for what happens when it goes wrong, because it went wrong 15 months ago. When export controls landed on the H20 chip, Nvidia could not sell what it had already committed to build. It took a $4.5 billion charge. In that quarter, it booked $5.3 billion of inventory provisions. Last quarter, that same provisions line was $1.1 billion. So, cancelable is true. Costless is not. When demand for one product disappeared by decree, the commitments turned into a charge inside a single quarter, and the option to reschedule did not save them. Now, the other end of the same fact, because a commitment is only as good as the people who eventually pay you. In the same filing, Nvidia discloses how concentrated the money owed to it is. 3 direct customers accounted for 30%, 18%, and 16% of its accounts receivable. Add those up. 64% of everything Nvidia is owed by 3 companies. 1 quarter earlier, the same 3 lines read 25, 18, and 13. 56%. So concentration did not just stay high, it went up 8 points in 3 months. The company also holds $30.2 billion of marketable equity securities, stakes in the ecosystem it sells into. Put the two ends together. Nvidia has committed $119 billion forward to the people who supply it. 2/3 of what comes back is owed by 3 names, and it owns equity in the world those names operate in. Jensen Huang has been asked whether that is circular, and he rejected it flatly, calling the idea ridiculous. That is his answer, and it deserves to be on the record. Our reading is narrower than circular, and it comes back to the borrowing, which brings us back to where we started. In June, Nvidia raised about $25 billion of debt, in tranches running out to 30 years. Look at what that company already had. $50.3 billion in cash and short-term securities. $49 billion of free cash flow in the previous quarter alone. Around $8.5 billion of existing debt to deal with. The most profitable hardware company in the world, borrowing money it plainly could have generated by waiting 1 quarter. Here is our reading of it, and again, this is ours. You do not raise 30-year money to cover a working capital gap. You raise it when you intend to keep spending through a period you cannot forecast, and you want the funding locked before you find out whether you were right. That is the same decision as the commitments line taken on the other side of the balance sheet. So the picture is not a chip company having a good year. It is a chip company that has decided to carry the financing risk of an entire build-out on its own balance sheet. Committed at one end, concentrated at the other, funded in advance, which makes one number on Wednesday the one that matters. So here is exactly what to do. Wednesday, after the close, the results come out and then the quarterly filing follows. Do not stop at the press release, because the press release will not have it. Go to the commitments note. Find the line headed Manufacturing, Supply and Capacity Commitments. Same words, same note. Compare it to $119 billion. If it is meaningfully higher, Nvidia's own conviction is still rising, and it is putting more of its own money behind that view. Whatever the share price does that night, that is a company still accelerating. If it is flat, that is the first quarter in 2 years where it stopped. Flat is not a collapse, and 1 quarter is not a trend. It is the earliest reading you can get, and it arrives a full quarter before revenue could show you the same thing. If it falls, the speedometer is going the other way. One warning about the comparison. Older figures were reported under a different label, so do not compare against the 95.2. Compare like for like against 119. 3 things to take away. 1. Revenue on Wednesday is a number the market has already had since May. A guided print carries almost no information. 2. The commitments line is the only place where Nvidia has to spend its own money to be wrong, which is why both the bull case and the bear case quote it, and why it moves before anything else does. 3. It is a speedometer, not a verdict. Higher means conviction. Flat means the acceleration stopped. Neither one tells you what the shares are worth, and nothing here is advice. And one ask, which is the only one I will make. This is a weekly video. Every Monday, before the week opens, we take what reports that week and the one line that actually decides it. If that is worth having, subscribe, because this week we do it twice. On Thursday, we come back, open the filing, and read the real number against the one I just gave you. I have told you what I think it says. Then we find out. See you Thursday.